Imagine the government offered you a legal way to reduce your tax bill every year using your investment losses, and most investors have no idea it exists. It is called tax loss harvesting, and for anyone with a taxable brokerage account, it is one of the most powerful and most underused strategies in personal finance. This is week 12 of The Algorithm Investor and the second episode of Series 2. Today we are covering tax loss harvesting in full, what it is, exactly how it works, the wash sale rule that catches most investors off guard, when it makes sense to use it, and when it does not. Let us start with the foundation. When you sell an investment in a taxable brokerage account for more than you paid for it, you have a capital gain. The government taxes that gain. How much depends on how long you held the investment. Short-term capital gains, investments held for less than 1 year, are taxed as ordinary income. Depending on your tax bracket, that could be anywhere from 10% to 37%. Long-term capital gains, investments held for more than 1 year, are taxed at preferential rates. 0% for lower income taxpayers, 15% for most middle income taxpayers, 20% for high income taxpayers. This distinction matters enormously. Holding an investment for just 1 day past the 12-month mark can change your tax rate on the gain from 37% to 20%. A difference that on a large gain amounts to tens of thousands of dollars. Now here is where tax loss harvesting comes in. When you have investments in your taxable account that have declined in value, you can sell them to realize the loss. That loss can then be used to offset capital gains you have realized elsewhere in your portfolio. If your capital losses exceed your capital gains in a given year, you can use up to $3,000 of net losses to offset ordinary income. And any losses beyond that can be carried forward to future tax years indefinitely. Let me walk through a concrete example to make this completely clear. It is December. You have realized $20,000 in capital gains from selling some appreciated investments earlier in the year. At a 15% long-term capital gains rate, that is $3,000 owed to the IRS. You look at your portfolio and notice that one of your ETF positions is currently worth $8,000 less than what you paid for it. You sell that position realizing an $8,000 capital loss. That $8,000 loss offsets your $20,000 gain. Your taxable capital gain is now $12,000 instead of $20,000. At 15%, you now owe $1,800 instead of $3,000. You just saved $1,200 in taxes from one transaction. And here is the key. You do not have to stay out of the market. 31 days after selling the losing position, you can buy back into the same or a substantially similar investment and maintain your market exposure. You harvested the tax loss. You stayed invested. You reduced your tax bill. That is tax loss harvesting. Now the wash sale rule. This is the most important thing to understand about tax loss harvesting because violating it, even accidentally, eliminates all the tax benefits you were trying to capture. The wash sale rule states that if you sell an investment at a loss and then buy the same investment or a substantially identical investment within 30 days before or after the sale, the IRS will disallow the loss for tax purposes. The 30-day window goes in both directions. If you sold a losing position on December 15th, you cannot have bought the same security at any point between November 15th and January 14th. The entire 61-day window, 30 days before the day of the sale and 30 days after, is the wash sale period. Substantially identical is the critical phrase. Selling one S&P 500 index fund and immediately buying a different S&P 500 index fund from a different provider might trigger the wash sale rule because they track the same index and are considered substantially identical. However, selling VOO, Vanguard's S&P 500 ETF, and replacing it with VTI, Vanguard's Total U.S. Market ETF, is generally considered acceptable because VTI tracks a different and broader index. The positions are similar, but not substantially identical. Other acceptable swaps that maintain market exposure while avoiding the wash sale rule include selling VXUS and replacing with EFA plus VWO, selling BND and replacing with AGG, selling a technology sector ETF and replacing with a broad market ETF. The specific securities that qualify as substantially identical versus merely similar is a judgment call with some gray areas. When in doubt, consult a tax professional. The IRS applies this rule with significant discretion. Now let us talk about when tax loss harvesting actually makes sense and when it does not. Tax loss harvesting makes the most sense when your marginal tax rate on capital gains is meaningful. If you are in the 0% long-term capital gains bracket, which applies to taxable income below about $47,000 for single filers in 2025, tax loss harvesting generates no tax benefit because you are not paying capital gains tax anyway. It makes most sense for investors in the 15% or 20% long-term capital gains bracket who have meaningful taxable investment accounts, typically $100,000 or more, where the tax savings justify the transaction costs and administrative effort. Tax loss harvesting also makes most sense in years when you have significant realized capital gains to offset. If you have sold winning positions, received capital gains distributions from actively managed mutual funds, or are rebalancing a large portfolio, the losses harvested can offset those specific gains. When does tax loss harvesting not make sense? In tax-advantaged accounts, Roth IRAs, traditional IRAs, 401ks. Capital gains inside these accounts are already sheltered from tax. There are no gains to offset and no losses to harvest because no tax is owed on transactions inside these accounts. It also does not make sense if the replacement investment you would buy after the 31-day wash sale window is meaningfully inferior to the one you sold. The tax savings must outweigh any drag from holding a less optimal investment even temporarily. And it definitely does not make sense if you trigger a short-term capital loss that would have become a long-term capital loss with a few more months of holding. Short-term losses are more valuable than long-term losses. They offset gains taxed at ordinary income rates rather than preferential capital gains rates. But this must be weighed against the benefits of harvesting now versus waiting. Let us talk about how to actually implement tax loss harvesting in practice. The process is straightforward but requires attention to detail. Step 1. Identify positions in your taxable brokerage account that are currently showing unrealized losses. Look at your cost basis for each position. Most brokerages display this in your account overview, and compare it to the current market value. Step 2. Calculate the potential tax savings. Multiply the loss amount by your expected capital gains tax rate. If you are in the 15% bracket and have a $10,000 loss, the maximum tax saving is $1,500. Step 3. Identify a suitable replacement security that maintains your market exposure without triggering the wash sale rule. Have the replacement ready to buy immediately after the sale. Step 4. Execute the sale and immediately purchase the replacement security on the same day. Do not leave yourself out of the market during the transition. Step 5. Set a calendar reminder for 31 days after the sale. On that date, you can choose to sell the replacement and repurchase your original preferred security if you wish. Step 6. Document everything. Keep records of the original cost basis, the sale price, the loss amount, and the replacement security purchased. Your brokerage will issue a 1099-B at year-end, but maintaining your own records is good practice. One final important point about tax loss harvesting and long-term portfolio management. It is a tool to use when opportunities arise, not a strategy to pursue at the expense of sound portfolio construction. Never sell an investment purely for a tax loss if doing so meaningfully disrupts your long-term portfolio strategy or forces you into an inferior position even temporarily. The tax tail should not wag the investment dog. Used correctly and consistently over many years in a sizable taxable portfolio, tax loss harvesting can add the equivalent of 0.5 to 1.5% per year in after-tax returns, purely through intelligent tax management rather than better investment selection. Next week on The Algorithm Investor, Week 13, we are covering options basics. What options actually are, the difference between calls and puts, and how ordinary investors can use them for portfolio protection rather than speculation. For everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below Do you currently use tax loss harvesting in your portfolio? Yes, no, or never heard of it before today? I read every single one. See you next week.